Moving on now, and self-managed super funds are holding on to their shares despite the volatile market. At least that's the findings of a new group set up to represent the do-it-yourself super investors. Grant Abbott, Australia's Self-Managed Super Fund Members Association CEO, joins me now live from our Sydney studio. And Grant, it's the first member survey, the inaugural release. What does the data actually reveal about the outlook for the investment climate over the next 12 months?
Well, I think the main thing is it's quite scary just listening to the headlines there. It all seems doom and gloom, but I think people need to understand that SMSF investors or DIY investors are really long-term. And it's quite surprising, the survey of our members, which 20% responded to, showed there was only that around about 8% that were selling. The rest were either holding or dipping into the market when the markets actually dropped down.
Grant, we've seen that all superannuation basically is under pressure right now. There are no surprises there. But do SMSF members tend to be particularly stressed, do you think, as they are doing it solo?
Well, our survey showed that obviously it had an impact. I mean, you can't have a knock-off on the market in that respect without having an impact. But a lot of them are just sitting in cash, and for the last 2 or 3 years, really from the GFC, there's $116 billion. I mean, that's a lot of cash, $116 billion just waiting on the sidelines to pounce once we get a bit of stability and less volatility in the market.
So, I mean, we mentioned in the intro there that super funds or SMSFs were actually still sitting on that cash. They're not actually selling down on their shares, given the current conditions and recent growth downgrades from the IMF, I suppose, for both Australian and global economies. It does seem quite optimistic. What's driving the sentiment?
I think there's a difference, and people have to understand that when you're in a self-managed super fund or a DIY fund, you're in there making decisions for yourself and your family, as opposed to industry funds or retail funds who actually have to appease, I suppose, their broader constituent network. So really, for example, a 55 or 60-year-old, when they're investing in the market of a particular stock, whether it's BHP, NAB, Westpac, as long as the dividend flow comes through and those fundamentals are okay, really, they should be looking at a situation that those shares should be passed on to the next generation once they die and passed out of the self-managed super fund. After all, what's the reason to really sell those investments? And that's what we found from the survey, is that people have a very long-term, like a Buffett-style thinking.
All right, so it's shares or cash. What's the percentage of cash that most SMSFs are sitting on right now?
Probably around about 60% of the survey showed that it's around about 40% or less. So, again, that's sort of looked at from the ATO statistics, as I said before, $116 billion in cash. Wouldn't you like that to be awash in the market at the moment?
Absolutely. What are they forecasting for the year in terms of return and strategy moving forward?
Again, I would say that, just harking back to the headlines, no one really knows what's going on. Most of the people in the cash are getting around about 6%, but they're happy with the dividend yields they're getting from the Telstras, the NABs, the Westpacs, and they're moving down forward. One of the big changes, I suppose, in the last, in terms of investment strategy in the last 6 to 12 months has been a gradual move into property, quite away from shares, where people can now borrow to go into property. So we've started to see a little tick up in terms of the property, but certainly it's nowhere near as significant as cash and also shares.
Do you think that's because, and what we are also hearing from reports today, that property prices are at all-time lows, or is it because of the market conditions?
Look, I live on the Gold Coast, and I can tell you there, you're looking at about 50% down on property prices. And again, if we go back to that long-term thinking of the average self-managed super fund investor, as opposed to other sort of investors, that really, again, getting in property now, it's a pretty bargain price. And as long as it's giving you that yield, that cash flow, in order to fund your own private pension over a period of time, it's not a bad investment.
And just very quickly, Grant, given the size of the sector out there, why hasn't there been a body to act in the best interest of participants?
Yeah, it's quite surprising, given that there's, I mean, even last year there were 60,000 new members inside self-managed. There's now around about 900,000 members in self-managed super funds, controlling $420 billion of investment compared to only $250 billion in the industry super fund network. So I just think it's never been, it's been tried a couple of times, but it's never been thought of that really we need a lobby group. If the government's going to make changes, and guess what, they will, they'll start to target our sector because it is so big. We really need to forge and be together as a group to ensure that our future retirements are protected.
All right, Grant Abbott, Australian Self-Managed Super Fund Members Association, appreciate your time this afternoon.
Thanks, Moira.
Time for a break. Up next.